So if you think back to chapter 2, in chapter 2, we talked about the different financial statements. If a company is a public company, meaning they sell their stock on one of the it's publicly listed to sell on one of the stock exchanges, they have to make certain documents available. That includes 4 financial statements. We talked about these in chapter 2. We have the income statement. The income statement shows a company's revenue and expenses, which helps us arrive at the company's net income or net loss. The next statement was the statement of retained earnings. If you remember how to solve for retained earnings, it was our beginning retained earnings plus the company's net income minus dividends paid equals our ending retained earnings. Then we learned about a company's balance sheet, also called statement of financial position. On the balance sheet, we see a company's assets, liabilities, and stockholders' equity. Equity, we learned last chapter, is made up of 2 components, retained earnings being one, the other being paid in capital, which includes common stock, preferred stock, all those accounts we talked about in chapter 14. And then finally, the last financial statements that public companies need to furnish is that statement of cash flows. So what you see on a company's statement of cash flows is it's going to list all of a company's cash inflows and cash outflows. Right? So cash inflows, that's money that comes into the company, right? So it's going to be, where does that money come from? What's the source of that money? Is it from customers? Is it from bank loans? And cash outflows, where is it going? What is it spent on, right? Is it spent on paying our employees, to pay our vendors for inventory purchases? We get to see the uses of the cash and the sources of the cash. And just a little bit of interesting backstory. The first 3 statements, those became required in 1933 when these requirements were first put into place. This last financial statement wasn't required until 1987. And the reason for that was there was actually a very large bankruptcy at the time that really shocked the financial world, because this company everyone had been counting on, it was called W.T. Grant. It was a really big store back in the first half of the 19th or 20th century. It was the second largest bankruptcy at the time. And it was one that it was a company everyone recognized. They had over 1,200 locations. They were in Times Square. They were the 5th largest retailer at the time. And their stock was traded heavily and well above what it was worth, about 20 times what it was worth. And the company had shown net income for the past 3 years. I think it was like $96 million of net income for the past 3 years. And then all of a sudden, they filed for bankruptcy. They had losses of more than $131 million in that year of their final bankruptcy, which I think was in 1976. And so it really rocked the financial world. They said, how could we be so wrong about this company? Here we thought it was profitable, right? We had the income on the income statement, looked great, but then all of a sudden our investors lost, the value of their investment in this company's stock. And it was basically because we didn't have any window into the company's cash flows. Basically, what was the source of their cash? What happened with them is they were able to show high net income, They were recording sales revenue. Sales revenue, of course, increases net income. And they were basically allowing any customer to pay on account, in-house account, right? So accounts receivable went up, sales revenue went up, sales revenue represented higher net income for the company. But these customers, since there was no, reference checks, no work employment history, these customers never paid off their account, right? So they never got cash to come into the company. And of course, the company can only last so long without having any cash. So that was the big case that led to that fourth financial statement being created. All right, so in the next video, we'll talk about what that statement looks like.